Hi, my name is Ben Reppond. Today is January 24th, 2024. Welcome to my YouTube channel. Yesterday, Tuesday, I covered a piece, and I'll summarize it today, that is the S&P 500 is valued at about 23 to 1 price earnings ratio. The norm, the average, is about 19 to 1. So it is overvalued about 20%. So if you said if stocks were fairly valued, not overvalued, that would mean that stocks, using one method, that stocks would need or should have a correction down of about 20%. What's happened is during the last part of 2023 and maybe some in 2024, stocks have continued to go up and up based on good news, but they have overshot what the norm is for the price to earnings ratio. So in other words, the earnings don't quite support the level of prices. So if you want to say, is this a dangerous period to invest in the market? I don't know. I'd go so far as to use the word dangerous, but I think they are overvalued, and at some point we'll have some kind of a correction. So just for investors or traders, word to the wise, that be careful. Okay, I want to get into the dashboards. The first one is the major indexes. I have 6 major equity indexes and a government bond index. So these are listed top to bottom from how they have performed so far this year, 2024, and that is, I put that in the pink box to the right. And so you can see that the NASDAQ 100 is up 2.85%, the S&P 500 is up 1.5%, and the Dow is up almost 0.5%. All the others are negative, including the Russell 2000, emerging markets, and the 20-year long-term government bond, all down over 4% already in 2024. So it is a mixed market, but from that standpoint, it is more negative than positive. In the yellow box, kind of similar to that, in the yellow box is the performance for this past week. Again, you see those same top 3 listed there, and then the ones that are the worst listed there. Particularly, the thing that is of most note to me is the last one, which is the 20-year government treasury bond, which is the most negative of all of those, and that is not good for traditional buy and hold 60-40 stock bond portfolios. Not everybody who is in a 60-40 or buy and hold portfolio is using the 20-year government bond. I know that. But they may be using an intermediate term bond or corporate bond. But this is just an indication of the degree to which bonds are underperforming for 2024. To the right of that, you see how they are performing relative to their moving averages, going from left to right. The 20, 50, 100, and 200-day moving averages. If it's a green dot, that means they're above that average, and if it's a red dot, they're below that average. But you can certainly see the last couple of them, the emerging markets and government bond, are quite negative. When we take the S&P 500 and break it down into its 11 component parts, the 11 sectors of the S&P, we get something that looks like this. And again, I order these from best to worst in the pink box, year to date. So by far, the best performer is healthcare. And positive is consumer staples. Those are considered the in my opinion, the 2 most defensive sectors in the market, and they are leading the market. The rest of the market goes down from there, all the way down to the bottom, which is retail, which is down almost 5% year to date. When you look at the To the right of that, on the green dots and red dots, the most negative one is energy. It has been down quite a bit, and it is negative to all of its moving averages for the year. Well, actually, it's the 20, 50, 100, and 200, so over the periods of time. And yeah, so basically, when you look at the internal components of the market, it's fairly negative at this point. So I'll show you some positive things, but this tells kind of a different story. This is what I'm referring to. So the S&P 500, look at where it has gone. Now, it's been up and down for sure, but look at where it's gone since the beginning of November. It has gone quite a bit up, and including this past week. You can see the far right of the chart, how much up it is. But compare that to the data that I just showed you and how many components in there are negative. It's very interesting that the S&P 500 can do that well with that much negative drag on it from those sectors. So I would say right now it looks like the market has got a head of steam. Looks like it's going to continue to go up, at least for the time being. The other thing I do with the market is separate, in the S&P 500, separate growth stocks from value stocks. Growth stocks are companies like Google, Apple, Amazon. Value stocks are companies like Ford and Boeing and Pfizer and JP Morgan and so forth. Those are very different kinds of companies. So you can, and I put those on a ratio. So I put growth as the numerator, value as denominator. So when it goes up, that favors growth. When it goes down, that favors value. Since October, you can see this line that goes, up and down line, has gone down till about the beginning of January. What that tells you is that value stocks were in favor during that period of about 3 months. Then, on or about January 1, it turned around and growth stocks went back into favor. So you can see that, I put a circle around it, you can see the degree of the trajectory at the end of the chart, how much upward momentum it has, which favors growth. The market itself may go up or even down, but when compared one component to the other, growth is certainly at this point has been in favor. The other relative strength chart that I show is the S&P 500, which is the largest 500 companies, divided by the smallest 2,000 companies, small caps. And that's measured by the Russell 2000 Small Cap Index, IWM. Same thing. So it's interesting that small caps were in favor, causing it to go down during that 3-month period, and then toward the end of December, large cap came into favor, looking kind of like growth and value. Pretty interesting. So next, I'm showing long-term government bonds, and I showed the TLT, the long-term government bond, before, and how poorly it's done this past week and year to date. And you can see that at the end of this chart, as it starts to come back down. It had gone up during the last couple of months of the year, and now it's coming back down. So what is it going to continue to break down further? Of course, I don't know that, but it did not surprise me, because I thought it was taking off too quickly, and this is very much a function of interest rates. The direction of this is usually inversely correlated to interest rates. This is the dollar, represented by the ETF UUP, and you can see at the very far right of the chart that the dollar is strengthening, is going up. Prior to that, for the past 2 or 3 months, it was falling, but over the longer period, the dollar is strong. When you compare, this is when the dollar, since we're the reserve currency, if the dollar is always being compared to other currencies, and perhaps Japan and certainly Europe And so if you are buying goods or traveling into another country, typically, and I'll just use Europe as an example, if you're traveling, your dollar is going further and further by having a strong dollar. On the other hand, if people from those countries are coming here to use their currency to buy goods in America where we have the dollar, their dollar does not go as far. So it's weaker relative to the dollar. Gold has also been coming down. You can see that for the past 3 or 4 weeks. And but longer term, over the past 14, 15 months, it has been in an upward trajectory. Silver kind of tends to follow gold, but not precisely. So I drew an arrow here to show since the month of May, silver has generally been in a downward trajectory. A lot of up and down, but generally more down than up. When you compare the two, silver versus gold, silver numerator, gold denominator, so if it goes up, that favors silver. So as it declines, what that is saying is that gold is a better value relative to silver during that period of time. Okay, the volatility index. Now, the volatility index shows that the further down it comes, it says basically there's less volatility in the market. The index is called the VIX, V-I-X, volatility index. And so I take it from October of 2022 to present and put a black line so you can see the degree to which it's gone from about 32 down to 13. So that's a huge drop, which shows that the market, the equity market, is stronger and more positive and less volatile. I drew a red arrow from about November to present to show the magnitude of the decline, and again, the strength of the market during that period of time. So it's not only going down, it's going down at a faster rate. It got down around 12, but that's 13 or 12 is a very low number historically for the volatility index, and that even though there was a slight increase this last week, it still is quite a bit indicating that the market has got stability in it for now. Asbury Research, this has been becoming more and more negative over the past 3 weeks, and there's of the 6 indicators that are mostly fundamental indicators. It's a mix. There's fundamental and technical here. You can see that only one of them, the relative performance of stocks versus high yield, the bonds, that's the only one positive. All the other indicators have turned negative, which is, from Asbury's standpoint, a bearish indicator of the market. Cross-asset relative performance, again from Asbury, comparing one class of investment to another. So stocks versus bonds, stocks are more favorable. Large cap versus small cap, large cap is more favorable. Broad market versus the blue chips, the 30 stocks and the Dow, the broad market is stronger. Technology versus the broad market, technology is stronger. Growth versus value, growth is stronger. We saw that. And this is measured over the last week, the last month, the last quarter. And then corporate bonds versus government bonds, corporate is stronger. Now this is an interesting chart because I don't think I've ever shown this to you when there has not been a green box. So I'm not going to read all the countries here, but virtually every country, the U.S. is stronger than that country for the last week, the last month, and the last quarter. Europe, Asia, Pacific, zones as well as countries. There's only 3 exceptions that don't have all 3, and that's Japan, Taiwan, and India, and they only have 1. So the U.S. is a stronger market as of now. And this was covered with green boxes showing other countries were stronger than us sometime during this past year. Okay, so based on that last chart, I pulled one country to just give you an example of this. I pulled France, and I could have pulled the Eurozone, for example, but I pulled France just to show the degree to which the U.S. market, not the economy, but the market represented by SPY, is stronger than other markets. And I picked France. So you can see from May to present by the black arrow the degree to which U.S. SPY is outperforming the equivalent in France, EWQ. As of last Friday, gold and silver had a slight decline from the previous week. The gold spot price is at 2031. That's down about 1% from the previous week. And silver is 2268, down about 2.5% from the previous week, the previous Friday. That gives a gold-silver ratio of 89-1, almost 90-1. And so this is getting to the range where silver is becoming more and more attractive the higher that number becomes as a good value. A monster box, 500 generic rounds of silver it's called a monster box, silver bullion, is going for $12,465. This includes the spot price, which I just told you, plus the markup of $2.25 per ounce, and that makes the cost $24.93 per round, including the markup and the spot price. If you get it in the quantities of like one tube of 20, that goes up to $25.43. And I get this information from my son, Preston, who sells them at that price. And I encourage you to use this. If you want to buy this, you use it to buy locally and to buy from a brick and mortar retailer. Well, thank you for watching. I hope this was helpful. If you have questions or comments, leave them in the comment section below.